Good evening to all. Welcome to special lecture series program for undergraduate students, finance and its allied areas organized by Kolkata Bidhannagar Society for Academic Advancement, West Bengal, India and coordinated by Azure Academic Services, West Bengal, India. Today's topic of discussion is income under the heads of house property. Today our guest faculty is Sayak Mitra sir, who is Assistant Professor of Department of Management Studies at St. Xavier's College Autonomous, Kolkata, West Bengal, India. Over to you, sir.
Thank you so much. So, without wasting time, so I'm just starting my presentation. Okay. Thank you so much.
Sure, sir. Thank you.
Is it visible?
No, sir. Right now it is not visible.
No, there's a technical problem. Now it is recovered. Okay, I'm just starting presentation. Now see it is visible.
No, no, no. It is not visible.
Connection issues are there. So I'm rejoining there.
Oh, okay, sir. Okay.
There is a connection issue actually.
Yes, I think there is a connection issue.
Yes, I'm just trying to restore it.
Okay, okay. Take your time, sir. No issue. You can continue, sir. Sir.
Okay.
Yes.
Good evening, everyone. So this is I'm going to start a topic basically on income from house property. I think it is known to everyone that among the five important heads of income under direct tax that we have, income from house property is going to be a very important one, and we will be for from now for a few time, probably 1.5 hour around, we'll be discussing on this topic specially, right? Now, please move the slide. So this is first thing that we need to know when we go for the income from house property. That is, what is a house property, right? First, we need to identify which property is a house property. Now, any property is not a house property. So whenever we need to identify a house property, then we have to consider that this property must be any building or a land appertinent thereto. And this appertinent thereto is a legal term. It means what? Any building or any construction that we have, it must be attached with the uh, must be attached with the soil, right? So this term is very important in this regard. So anything, it is not necessarily that it is a proper build up construction. A ground, a playground can also be uh, unhoused property. Why? Because this playground that we actually have, like Eden Gardens and all these things, there is a capacity that where the spectators can come and they can enjoy a match. So this can also be regarded as a house property. So house property is any property, as per the definition of the tax. House property is any property that is a land appertinent thereto. So any property which is attached to a land, this can be regarded as a house property. Second one, when we are supposed to find out the income from house property, that is basically regarding a owner. That means if someone or some assessee having such income from house property, he or she must be the owner of that property. That is then essential condition along with the land appertinent thereto. So to be very specific, a person having a land appertinent thereto or any building, and he or she is the owner of the property from where they're having some earning, this earning is supposed to be taxed under the head house property, right? So this is the basic thing that we need to understand when we go for house property. So any income that we generates from any house, building, bungalow, godown, playground, these things, that is a land appertinent thereto, that is basically known as the uh, sources of house property. And if we have any income from these properties, that is very much and mostly taxed under the head house property. Now, please go, change the slide. As we know the basis of charge in case of house property, but we have to understand one basic thing, that how many types of house properties are there as per the provisions of income tax. So income tax has different provisions for different types of house property based on its usage, right? So basically, if we have one house property, we use this house property basically for different purpose. So if we broadly classify the purposes, so first one is let out. If any person having any house property and he or she use the same property to let out purpose of their tenant. Say for example, one person, he is giving his property to a tenant, and against that they are taking some sort of rent from them in a yearly basis or monthly basis, whatever it is. Now this can be taxed, or the income from that house property can be taxed under the head house property. So this type of property is known as let out house property. Okay. Next one, that is that we have another type of house property, that is we can use the house property for our own residence purpose. This is known as self-occupied house property. However, based on the type of house property, this is the tax treatment is different, right? If the property is a let out property, then irrespective of its use of the tenant, that means a tenant can take a property in rent from a owner of the property, and he can use the same either for his residence purpose, or he can use the same for his business purpose. It doesn't matter. If there is a let out property and a person having income from the property, being the owner of the property, that is chargeable under the head house property, under the head income from house property. But if a person is using his property for its self occupation or self occupant's purpose, so at that time these properties is basically uh, charged under the head house property. However, if a owner of the property actually having income, owner of the property uses his own house, but for his own business purpose, that is not charged under the head house property. So to be very specific, I'm just telling that in case of a let out property, there is no such question that whether it has been used for uh, let out purpose or business purpose of the tenant. If it is let out, then it is directly chargeable under the head house property. But the thing is, if the property is a self-occupied property, then we have to consider that whether the property is being used for business purpose or the owner's residential purpose. If the property is used for owner's residential purpose, then it has been considered under that house property. But if the same has been used by the owner for his or her own business purpose, then it is not chargeable under the head house property. It is chargeable under the head profits and gain from business profession, right? And last one, there is another point we have given. If any flat developer, any house construct any flat developer or any building developer is there, and he is making, and he is the owner of few flats and few house building, but the same he is actually keeping for sale purpose, this is also a part of their stock in trade. So that is why it is also chargeable under the head house property. So just two things I'm just telling. If any property one owner using for his own business purpose, and if one owner is constructing one house property just for its sale purpose, in these two cases it is not chargeable under that house property. So any property let out for any purpose, whether it is business purpose or self occupancy purpose of a tenant, it is chargeable under the house property in the hands of the owner, right? And if any self occupied house property we have, then we have to check whether it is used for the owner's residence purpose or it is owner's business purpose. If it is used for owner's residence purpose, then it has been considered under the head house property. Okay, please change the slide. Now, as we know that if we have let out house property and if we have self-occupied house property, these two are chargeable under the house property. But whenever we will compute the income from house property, there are different things we need to know. It is not exactly what the rent we are getting, it will be regarded as the annual income from the respective house property. If we use for residential, if we use for let out purpose, right? So for computation income from house property, we have to know few definitions in this regard, right? So these definitions are this. First one we need to know, that is the municipal value. Now, what is a municipal value? Municipal value of a property is that value which is being fixed by the respective local municipality where the building is situated. Say, for example, one building is situated at Damdam area. So, Damdam municipality is valuing the property and they have their own rules for valuation. And this valuation is basically done for computation of the municipal tax on that property, right? So, this valuation of the property made by the local municipality, that has been regarded as the municipal value, and this municipal value will be used by the respective uh, mm, will be used for further computation purpose, right? Second one we need to know, that is fair rental value or fair rent, we can call in simple terms. What is a fair rent? Fair rent is a standard rent that is actually asked by the different landowner, different house owners at the area where the house is being situated. Say for example, the house is situated at Damdam. So in any area, say for example, Damdam, near the Damdam metro station. So near the Damdam metro station, there are other house owners, those who are also given their property in rent. So say for example, this person is taking monthly on an average. On an average, all these house owners are taking monthly 10,000 as a rent. So this 10,000 will be the fair rental value of the property. And in annual value, if we compute, so it will be 10,000 into 12. It is the fair rental value. But another thing we also have to consider, that is standard rent. So why it is standard rent? Standard rent and fair rent, these two things are different. Standard rent means it is that rent which has been fixed by the Rent Control Act. So the standard rent and fair rent can be different. What the owners are asking, it might be more than the rent fixed by the Rent Control Act. And Rent Control Act fixes the rent as per their own computation, like municipal valuation, right? So this annual valuation of the property as per the Rent Control Act is known as the standard rent. And the last one that we have, it is our actual rent or rent receivable. Now, what is actual rent or rent receivable? Actual rent means the rent we are actually getting or yet to be received from certain tenant if we keep the property and if we give the property for their usage purpose, right? So that is the actual rent we have to consider. Please change the slide. Okay. Okay, go to the next one, please. So here, what we are supposed to do, that is basically for a let out property, if we are supposed to compute the income, first we have to find out two things. The first very much important thing we have to find out, it is our gross annual value, right? It is our gross annual value. Now, this gross annual value, how we can compute, right? Please go to the next and next slide. Yes, this one. So here, two terms we have to consider, right? When we are supposed to compute the income from house property, first we have to find out the gross annual value. Now, how to compute the gross annual value? There is a section 23 subsection 1 clause A. Here, the basic thing they have given, it is the first we have to find out the value of reasonable expected rent as per section 23 subsection 1 clause A. Second we have, that is our actual rent receivable, right? And as per this provision, this is higher between these two value will be regarded as the gross annual value. Say for example, reasonable expected rent of a property, it has been calculated in a different way that I'm coming, but for now just listen. Here the reasonable expected rent for a property, say for example, is 1,20,000 annual valuation, right? And annual rent they are expecting every year is 10,000. So there, say for example, their annual value, annual rent they are taking, say for example, is 11,000, right? So 11,000 into 12, that will be their total actual rent receivable they have. And reasonable expected rent that is given, it will be given in the question or it will be given there. This is the value of the reasonable expected rent is, say for example, 1,20,000. Now we have to check between these which one is higher. This higher one among these two, reasonable expected rent and actual rent received, this has been considered as the gross annual value, right? Now, to be very specific, how to find out the reasonable expected rent itself, that we need to know again, right? Now, this reasonable expected rent under section 23 subsection 1 clause small a, it is itself of higher of two things. First, we have to consider what is GAV. GAV is the higher of reasonable expected rent and actual rent receivable. Now, how to find out the reasonable expected rent, that we are discussing. When we are supposed to find out the reasonable expected rent itself, then we have to find out higher of two values. One is municipal value, second one is fair rent. But we have to keep it in mind one thing: it should not exceed the standard rent of that property. So just I am giving you an example. Say for example, municipal value of a property is 1,50,000. Fair rent, annual value of fair rent of that property is 1,30,000. Now, among the municipal value and fair rent, which one is higher? Municipal value, that is 1,50,000. But 1,50,000 can be considered as a reasonable expected rent if the standard rent is more than 1,50,000. Say for example, the standard rate is 1,80,000. Now, municipal value and fair rent, which one is higher, will be regarded as the reasonable expected rent. But if in any situation municipal value is 1,50,000, fair rent is 1,30,000, now among them which one is higher? Among the municipal value is higher, so we will be taking initially municipal rent as the value of reasonable expected rent. However, we have to also check at this simultaneously, that what is the value of standard rent at that time. If the value of standard rent at that time is less than your higher of municipal value and fair rent, say for example it is 1,20,000. Now this standard rent and higher of municipal value and fair rent, which one is will be lower, it will be regarded as the reasonable expected rent. This part is little bit confusing, but the thing is basically we have to check municipal value and fair rent, which one is higher, but it should not exceed the standard rent. So if in any situation standard rent is more than higher of municipal value and fair rent, in that case higher of municipal value and fair rent will be regarded as the reasonable expected rent. But if at any situation municipal value and higher of municipal value and fair rent is more than the standard rent, then standard rent will be finalized as the reasonable expected rent as per section 23(1)(a). I think this part is clear. Now go to the next slide. Now, second thing we have to consider, that is actual rent receivable. First we have to find out what? Reasonable expected rent, and how to find out this I have discussed. Second step we have to find out, that is our actual rent receivable or actual rent received. Now finally we will compare the reasonable expected rent and actual rent received. Basically higher of these two will be regarded as the final gross annual value. Now if we go for the actual rent receivable, it will face few, we have to find out few issues regarding the actual rent receivable. There is two issues we have to consider. One is unrealized rent and second one is vacancy period. Now what is this? Unrealized rent means, say for example, a particular person is residing in a property for 12 months. However, he has paid rent for 10 months. 2 months rent, yet 2 months rent is still due for that person. That means the owner is yet to receive this 2 months rent. Now, what is their actual rent they have received? It is not, say for example, monthly rent is 10,000, but they have received in real terms in cash actually 10 months into 10, so it is 1 lakh. But they are supposed to receive in an year the total amount of annual rent is how much? 10,000 into 12, that is 1,20,000. Now here the actual rent received is less than the actual rent receivable, right? So in this way, the actual rent receivable and received, that value can differ, and the difference is caused by one point, that is unrealized rent. Unrealized means the rent not yet realized by the owner of the property, right? Next one, that is our vacancy period. Now what is a vacancy period? So from the name we can also understand that vacancy period means during the time the tenant was actually not there in the property which he has taken in rent. This period is known as vacancy period. It can be of any month. If we go month wise, it can be of 1 month, 2 month, 3 month, 4 month, whatever it may be. But the difference between real unrealized rent and vacancy period is, unrealized rent means the rent that they have stayed, they have not vacated the house at that time, but they have not paid their total rent for 2 months. It is unrealized. That means it is yet to be realized. But vacancy period means the period they have vacated the house. That means at that time they have taken in a rent this house, but they have not there, they have not occupied at that time that property. So for that purpose, income tax has given few exemption. That means your actual rent receivable can be reduced due to these two reasons. If you have if you have unrealized few rent, and if there is some vacancy period you have, right? Now if we consider these two things, then higher of reasonable expected rent and actual rent receivable will not be the final gross annual value. We have to consider these two things with the actual rent receivable, and accordingly we have to find out the respective value of the property, right? So you kindly change the slides. Please go to next slide, and next one. Yes. So I think there are 4 cases will be there. If we consider that these two things, there will be 4 cases there, and in 4 cases the GAV will be different in this 4 case. Now let us understand these cases one by one. Say for example, in a property, I'm just giving an illustration that will be better. Actual rent that we are receiving for a property is 10,000. Now expected rent, as we have computed from the previous step, the step was, it is the higher of municipal value and fair rent, but subject to maximum of standard rent. Say for example, this value is 1,30,000 and actual rent 10,000 per month. So 12 months rent is how much? 1,20,000. But during that particular period, the respective tenant who has taken the house in rent, he has vacated his house for 2 months, right? Now during this period, during this period, he has vacated the house. Now this actual rent in income tax computation, when the owner will disclose, they will deduct his actual rent by this 2 months vacated period. So in real terms, if we check, the person's vacancy period will be 10,000 for 2 months. So total 20,000 will be deducted from 1 lakh. Still he is given in a rent, but he was vacated this house for 2 consecutive months, right? But see here, the expected rent that we are considering, it is, we have considered for all the 3 cases, that is annual, municipal value, fair rent, it is in 12 months or annual basis. Now we can't compare these two. Why? Because expected rent is computed in 12 months basis, but actual rent is computed in 10 month basis, because there is 2 months vacancy period, right? So at this situation, we have to consider that what would be the expected rent, that is the reasonable expected rent, if the respective owner would stay for 10 months. That is 2 months we have to deduct from the reasonable expected rent to, then we can compare the actual rent and the revised expected rent. Say, for example, here in this case, vacancy period was for 2 months. So, for how many times they have vacated their house? For 2 months. So, 10,000 into 2 months, 20,000 is the total amount of vacancy period, the rent he has actually deducting from his actual rent receivable. Now, the same amount we will also deduct from reasonable expected rent. So, our annual reasonable expected rent was how much? 1 lakh 30. So, from 1 lakh 30, we will deduct this 20,000. So, what is the resultant figure? 1 lakh 10,000. In case of actual rent, what is the figure? 2 months vacancy period was there. So, 10 into 2, 20,000, 1 lakh 20 minus 20,000. Right? Now, and in this case, if we go for the GAV, now what will be the value of GAV? So, as per the normal rule, if we have don't know we don't have any vacancy period, if we don't have anything, any unrealized rent in anything, the rule is for GAV it is the higher of reasonable expected rent and actual rent. But if vacancy period concept exists, then you just check in our situation, expected rent is 1 lakh 10 and actual rent is how much? 1 lakh 20 minus 20,000, that is 1 lakh. Now, among them, which one is higher? Still, the expected rent is higher. But as the vacancy period exists there, we will consider actual rent as if the GAV. It is an exceptional case one for computation of GAV. I think this part is clear to everyone. Now, there is another situation which is named as case 2. So, what is the case 2 situation? Here also, actual rent is less than expected rent. So, what is the expected rent? Expected rent here in this case, because of loss of vacancy and other factors like unrealized rent. So, here we have considered two consecutive situations at simultaneously. Say, for example, the respective tenant vacated his house for 2 months, and for 1 month he has some unrealized rent, right? Total how much periods, how much times or how much months rent the owner can deduct from his computation? 3 months, 2 months for vacancy period and 1 month for unrealized rent, right? Now here still expected, that is reasonable expected rent that we have computed, it is also annual rent basis, right? Now here in this case we have to again deduct expected from the expected rent the amount of vacancy period, not unrealized rent, right? If we have unrealized rent and vacancy period both, then from reasonable expected rent we will only deduct the loss due to vacancy period, and from expected rent if we deduct loss due to vacancy period, this is known as the gross annual value. Now question will come, why we are not supposed to consider the actual rent here? If we consider, what will happen, it is actually lower than the expected rent. How? You just check, actual rent is how much we have received, 2 months vacancy and 1 month unrealized rent. So if we have 12 months rent, 10,000 for each month, we have actually received for 9 months rent. So 9 into 10, it is 90,000 our actual rent received. But our expected rent, as we have given in case number 1, it is how much? 1 lakh 30. We are also considering this 1 lakh 30. Now from the expected rent 1 lakh 30, we will deduct the loss due to vacancy, and unrealized rent is also there. Now in that case, obviously actual rent will always be lower than the expected rent because these two things simultaneously exist. So that is why we do not consider the actual rent anymore. We will consider the expected rent as if our actual rent, and from that we will only deduct loss due to vacancy. The resultant figure we will consider or finalize as the gross annual value. So I think this case 2 is also clear. Now the case number 3. It is a situation where actual rent is less than unexpected rent due to other factors. So only if we have unrealized rent, but we don't have any vacancy period. So that, to be very specific, I am telling, if we have vacancy period, then we have to consider this case number 1 and 2, unless there will be no problem. Unless for each case, basically higher of these two will be regarded as the value of gross annual value. But if we have only unrealized rent, but we don't have any vacancy period, then also expected rent will be regarded as the gross annual value, because obviously the actual rent will be lesser than the expected rent. Okay. And in the case number 4, if the actual rent is greater than the expected rent, so it is the normal rule we have also know, that is, it is the higher between actual rent and expected rent, and there is no question of vacancy period, no question of unrealized rent. So at that time, higher between these two will be regarded as the gross annual value. So I think this part is clear. Kindly you just show me the slide number 8 where the format is given. Previous one. Previous one. Okay, now check here. The gross annual value, how we can compute in different situations, we have detailed discussed. Now, gross annual value is not the income from house property. We have to deduct one thing more from the gross annual value. That is what? Municipal tax paid by owner. Right? Then finally, we will get adjusted annual value, or we can call it net annual value. Right? Then we have, it is a structure of computation of house property for a let out property. So then we have deduction under section 24. Two deductions we can avail. One is standard deduction under section 24A. Second one is interest on borrowed capital 24B. Then finally we can arrive at income from house property. Now let us discuss what is the municipal tax of the owner and how much amount of exemption we can claim from the gross annual value, and we can arrive at adjusted annual value. Kindly go to the slide. Name of the slide is municipal value. It is the last slide I have discussed. Please go to that slide. Next one. No, next one. Municipal tax. This one. Yes. So now this municipal tax, it is a separate thing that we need to know. Now, what is a municipal tax? The municipal value we have learned earlier. This municipal value is basically assessed by the respective municipality for computation of the municipal tax of the assessee. Right? Now, as per the rule, if we pay some municipal tax, that can be claimed as an deduction or exemption, we can say, from the gross annual value to finalize the net annual value. Right? But to avail the deductions, few restrictions and regulations are there that we need to know what is as per the provisions of the Act. Right? Now, here we have to compute, check that. First point, it is deductible on gross annual value. First of all, municipal tax can be deducted from only GAV as we have computed. Second one, municipal tax can be paid by two persons, either the tenant of the property or the owner. But keep it in mind, whenever we will be claiming for the municipal tax from GAV, it is obviously the owner's portion. If owners pay something, that will be considered only for municipal tax computation. Right? If tenant pays something, it will not be considered or not be given as the exemption deduction from the gross annual value. And the last one is, it should be considered on cash basis. Now, what is cash basis? Cash basis means, say for example, 10% municipal tax you have to pay on your municipal valuation. So your municipal valuation is, say for example, is 1 lakh. 10% municipal tax you have to pay on your municipal valuation. So your expected amount of tax will be how much? 10% of 10 lakh, that is 10,000. Right? Now, this 10,000, out of this 10,000, the owner should be paid. Right? If tenants pay something, it will not be considered at all. Now, the owner actually paid 8,000 till the end of the previous year for which they're computing tax. So 2 years, 2 months or 2,000 basically for that year is outstanding municipal tax. But here the owner can claim maximum 8,000 as he has paid in real terms in this year. This 2,000 he can't claim as it is outstanding. This is known as cash basis. How much they have paid in reality, that is basically the amount they can claim as the municipal tax. But one thing we also have to consider, say for example, in the previous financial year, that means this is, say for example, this is our financial year 23-24. In financial year 22-23, say for example, there is 2,000 outstanding tax, municipal tax, the owner is due, the owner has to pay the municipality, right? This 2,000 he is paying in the year 23-24, right? Now in the year 23-24, actually he is paying how much? He is paying 8,000 for this 23-24's total amount of municipal tax and 2,000 for the previous year's municipal tax. Now he can claim for 10,000, 8 for this year's and 2,000 for the previous year. So it means cash basis means in which year it has been paid, irrespective of its actual occurrence. See here, the 2,000 that we are actually claiming in this year, it is actually pertaining to the year 22-23. But we are claiming the deduction in the year 23-24. That we can claim here. Why? Because it is cash basis. At that time we have not paid. So that is why we are paying right now. Right? And also, if we pay in advance for the upcoming year, the next year is 24-25. So the upcoming year, if we pay in advance municipal tax, that we can also avail in the year of its actual payment in cash basis as a deduction from gross annual value. And last one is, if the property is located outside India and the tax levied by the local authority in any other country, that we can also consider for municipal tax exemption from GAV for the respective property. So I think this part is clear to everyone. Okay. Now, please go to the next slide. Okay. Now, this is the way we have computed net annual value, or we can have computed the adjusted annual value. Now, as we have computed the adjusted annual value, it is not our income from house property. From here, under section 24, we will have two deductions. What is the deduction? First deduction, that is section 24A. Under this section, we have a standard 30% deduction. So it means what? Say for example, after calculating your GAV and deducting municipal tax, your adjusted annual value of property, say for example, it is 1,20,000. Now is 1 lakh, out of this 1,20,000, you can claim direct 30% standard deduction under section 24A. So 30% of 1,20,000 will be deducted from standard deduction here directly. We are not supposed to do anything else. Second deduction that we can claim, here we have detailed discussions, that is for interest on borrowed capital or loan. Now what is this? And this is under section 24B. Now what is this interest on borrowed capital? Go to the next slide. Now see, interest on borrowed capital means what? Say for example, the house property we have given in rent, or we are using this for any purpose, self-occupancy purpose, or we are using the same property for tenants occupancy purpose, but whatever it is, we can claim interest that we are paying, not the principal. Say for example, we have constructed one property, and for that purpose we have taken a loan of 30 lakh. Now out of the loan of 30 lakh, we have invested few sum for construction of the property. Now, for this loan, we have to pay EMI. This EMI consists of two components. One is principal component, second one is interest component. Now, this principal component, it is available as a deduction under section 80C if we opt for old regime. But only for the interest, here we have this 24B, right? So what is this section 24B? 24B, under this section, if we pay the interest, not the principal, for the loan, we can claim deduction. But here, it is deductible on accrual basis. What is accrual basis? Even if the loan is not paid, it is just opposite of municipal tax. In municipal tax, we have discussed how much we have really paid in cash in certain year, irrespective of its occurrence, irrespective of its actual year of occurrence, it is allowable as a municipal tax reduction. But in case of accrual basis of interest on borrowed capital, whether you have paid the interest or not doesn't matter. If it is for this year, so for example, our year is 23-24. So your total due amount of interest is 1,20,000, so for example. So you can avail this 1,20,000 full as a deduction under section 24B as an interest on borrowed capital. But borrowed capital, if you have paid nothing at all in this year. But keep it in mind, if any previous or coming year's interest you have paid this year, for that you can't claim deductions for interest on loan. It is just the opposite of municipal tax, right? Now this includes few things. Interest on unpaid interest is not deductible. Say for example, if you are paying, when if you are supposed to pay some loan, repay some loan, and for that purpose you have unpaid few interest, and for that purpose you have taken another loan and paying again interest to that person from where you have taken the loan, that is not deductible. No brokerage and commission you are taking, that is not deductible. Now interest on fresh loan taken to repay the original loan. So the first thing is unpaid interest. So any unpaid interest is there, and to pay that interest only, you are taking paying interest for the loan, that you are not deductible. But if you take fresh exact loan just to repay the original loan, that is allowable for deduction. So for unpaid interest, if you take loan, not allowed. But if you take fresh loan to repay the original loan, that is the main loan, that is allowed for deduction under section 24B. And in case of a let out property, and here there is a bifurcation. Now the nature of the property, based on the nature of the property, how much amount you can avail for interest on borrowed capital, there is a rule. Now, if the property is a let out, we are discussing right now the let out property. So in case of a let out property, how much amount of interest it is allowable, it doesn't matter. You can take the total amount in the current year. Only two condition is there. It should be pertaining to the current year only. Even if it is totally paid or not, doesn't matter, right? So you can claim this. But if the property for which you have taken the loan, this property is you are using, that means the owner is using for his self occupants purpose, self residential purpose, then there is a limit for claiming interest on capital. Whatever they want, they can't claim, right? Kindly go to the next slide. Okay, here you just take okay, so before going to the self-occupied property, I'm just showing you the structure. Can you go to the upper side? That is the format for the self-occupied property. Previous one. This no, this not this one. Previous one. Go to the previous one. No. Next one. Slide 7. Yes, this one. Now check. So we have discussed till the let out property computation. So if we deduct these two things, standard deduction and interest on loan, finally we will arrive at income from let out house property. Now, if we have a self-occupied house property for our own self-occupancy purpose, then here the calculation is like this. So I think it is known to everyone, whenever we have our house for our own occupants, we are not supposed to get any sort of rent from any tenant, as we have not given the same property in let out purpose. So here, in case of a self-occupied property, keep it in mind, the adjusted annual value that we have computed for let out property separately. There are three steps. First, we have computed RER, that reasonable expected rent. Then we have computed ARR. Then find out which one is higher. Then it is the GAV. Then we minus. Then we deducted municipal tax, and finally arrived at adjusted annual value. But here, in case of self-occupied property, all these steps are not at all required. Why? Because we know that we are using our property for our own occupancy purpose. So automatically, in every time, the adjusted annual value for our own property will always be nil under section 23, subsection 2, clause small p. It's clause small a initially, small b for other reason, right? But here, still the adjusted annual value is nil, that is zero for any self-occupied property, but still we can claim deduction under section 24 only and only for interest on borrowed capital for 24B. Why this is given? Because sometimes what happen, for a self-occupied property, even we take loan from the financial institutions or banks, right? So for that purpose, we can claim interest on borrowed capital under section 24B. But how much we can claim? It is not like let out property. In case of a let out property, it is, there is no such limit. How much amount you have computed, you can claim the total amount as the interest from borrowed capital. As a deduction for interest on borrowed capital under section 24B. But in case of a self-occupied property, here there is a limit for getting the interest on borrowed capital. So we kindly shift to the 3 to 4 slides forward. Next one. 13, 14. Next one. Keep there. No, previous one. So here you can check if the property that has been using for self-occupation purpose or self-occupants purpose, here there is a rule. If we take the loan on or after 1/4/1999 and we complete our construction or the acquisition process of the property, if we acquire the property, then acquisition, and if we construct the property, then construction, within 5 previous years, starting from the year of its construction complete, we repay the loan within the 5 previous years, starting from the year of its construction complete, then only we can claim maximum amount of interest loan, that is 2 lakh. I'm again telling, if we take a loan on or after 1/4/1999 and we have completed the construction within 5 years from the date of year of loan taken, then only we can claim maximum deduction of 2 lakh from income under the head under the deduction 24B, interest from borrowed capital. But if all these conditions I have told, it is not maintained or violated, then in any case means, first case, in previous case we have told on or after 1/4/1999. So loan can be taken before 1/4/1999 also. So in that case, whatever may be the construction completed time and all these things, it is restricted to maximum 30,000 in a certain year. That means if we take loan on or if we take loan before 1/4/1999, it is 30,000. If the construction is not completed within 5 years from the year of its loan taken, then also it is 30,000. If the purpose for the first case, that is for availing 2 lakh interest on loan, the purpose for taking the loan must be construction or acquisition of the property. But it can be also the owner can also take borrowed capital from the financial institutions or bank, not necessarily for construction but for repair of the house property purpose. Then also, if all the other conditions are satisfied, then also maximum amount of reduction they can claim is how much? 30,000. Right? So I think this thing or this part is clear to everyone. Now go to the next slide. Okay, next slide. Okay. Now one thing is also there for the self-occupied property, that is interest during 2 period. One is pre-construction, another is post-construction. Now, what is pre-construction period interest and what is post-construction period interest? So this is another addition for 24A, 24B, that is from the date of loan taken till the date it has been paid. This period can be bifurcated into 2 parts. First part is known as pre-construction period. Second part is known as post-construction period. Right? Now, what is pre-construction period and how we can compute this pre-construction period? Now, pre-construction period means it is the date starting from the date of loan taken. Right? Say, for example, a loan is taken on 1st April 2002. So, the pre-construction period for that property will be started from the date of loan taken, that is 1/4/2002. Now, it will be ended on which day? Keep it in mind, it will be ended on the year of its construction. It will be ended on the immediately prior 31st March of the year of its construction complete. I'm just giving an example. Say, for example, the construction, we have taken loan on which day? 1/4/2002. Now, the construction, say, for example, is being completed on 2nd of April 2010. Now, immediately, so this 2nd of April 2010 actually belongs to which previous year in tax? It is actually our previous year 10/11. But what is the immediately 31st March prior to the date of construction completed? 31st March 2000, 31st March 2010. Right? So the pre-construction period will start, in this case, the pre-construction period will start from 1st April 2002 and it will be ended on 31st March 2010. Or sometimes what happens, before completion of construction, we can also repay the loan. We have taken the loan on which day? On which day? 1/4/2002. And construction was completed on 2nd of April 2010. But say, for example, in the year 2007, we have repaid the loan. Then the closing period, here in the first case, the closing period was immediately prior of 31st March of the year of completion of construction. But here in this case, it is started from the date of loan taken and it will be ended on the date of loan repaid, because before construction of complete of construction, the loan has been repaid. So basically, in technical term, if we go, the end date for the pre-construction period is the earlier of 31st March, immediately prior to the year of construction completed, or year of loan taken, whichever is early. Right? But during that time, whatever the total amount of interest you will compute, you will not be getting the whole interest in a certain previous year. That total amount of interest you have computed exclusively for the pre-construction period. So for example, in our case, 1st of April 2002 to 31st March 2010. So total interest during that period that you have computed as a pre-construction interest, that you will be getting in 5 equal installments starting from the year of its construction completed. So construction was completed on which year? Construction was completed on the year of 2nd April 2010. So starting from the year, for 5 consecutive years, you will be getting the total interest that you have computed here, right? So I think this part is clear to everyone. Now go to the next slide. And what is the post incorporation, post concession interest? Post concession interest means it is that part of interest. Say for example, and the post concession interest period will start from the ending of the pre concession of interest. So in the previous example, what is our end date of the pre concession of interest? The end date is 31st March 2010. So the post concession interest will start from the just very next day, 1st April of 2010, and it will extend it till the date of its loan repayment, right? So for example, the loan is repaid on 31st March 2016. So the post concession interest period will be 1st April 2010 up to 31st March 2016. And here it is within that period, it is given yearly basis, and for a particular period till the you are getting the pre concession period interest, it is you are getting one fifth for the 5 consecutive years plus post concession interest during the period, the total amount till the date of its loan repayment, right? So this is regarding the interest on borrowed capital and the pre-incorporation and post-incorporation interest computation, right? Next, go to the next slide. This slide is talking about property owned and co-owned by different owners. So sometimes what happens, the property can be owned by some co-owners. So what are the co-owners? So for example, one property I have that we actually own by any one particular owner. But sometimes what happens, one particular property can be owned by different co-owners. So at that time, how we can compute the income from house property? So if the property, here also the nature of property we have to consider. If the property is a let out property, then the income from such property shall be computed as if the property is owned by one owner, and thereafter the income so computed shall be apportioned among the co-owners as their specific share. So first of all, total income we will compute, and whenever they will show the income in their for their computation purpose, that will be regarded as the, and they will share among themselves. Say for example, for any property there are 5 co-owners. Now the total income from the house property after all the computation we have done already, the let out property, the total value of the total income from house property, say for example, is 5 lakh. So 5 co-owners are there, so it will be 1 lakh for each co-owners, right? Now if we go for a self-occupied property and the co-ownership concept exists, so in this case there will be no question of sharing of income from house property, because if the property is a self-occupied property, we know by default its net annual value is 0, right? But question will come, that is how they can avail the benefit of interest on loan under section 24B. And here we also know that there is a restriction. If the property is constructed on or after 1/4/2000 1999, and the construction was completed within 5 previous year from the year of its construction. From the year of its construction completed, then basically they will be getting 2 lakh, unless they will be getting 30,000. So in this case, if the co-ownership concept exists, then how they can claim, the each co-owners can claim the deduction of interest. The annual value of the property of each co-owner will be nil. I think it is known to everyone. If for any single owner it is nil, so it is nil for every co-owners. But each co-owner shall entitled to get a deduction 30,000 or rupees 2 lakh, as the case may be, on account of interest on borrowed capital. Now, if the co-ownership exists, then every co-owners, instead of a single owner, say for example 5 co-owners of a house property is there, 5 co-owners are there. Now the thing is, here in this case 30,000, if in the all conditions are satisfied, unless 2 lakh, if all the conditions are requisite conditions we have discussed is satisfied, they each co-owners will be getting the amount of claim as a interest on borrowed capital under section 24B. But if the co-owners, however, if the co-owners own another self-occupied property, the aggregate limit of loan will be restricted to 30,000 and 2 lakh, as the case may be. So it means what? Say for example, one particular co-owner is the co-owner of a property, as well as he is the single owner of another property. For the 2 properties, they are supposed to get interest from, they're supposed to get benefit for interest on borrowed capital. Now the total interest for these 2 property, one from being a co-owner and one from being a single owner, it is maximum restricted to 2 lakh or 30,000, as the respective case may be. This is regarding the co-ownership. Next slide. Second one is deemed owner. Sometimes what happens, we do not consider few owners as if owner, but as per the provisions of the act, these owners are considered as if a owner, as if an owner. So this is regarded as the deemed owners, right? Now, who are considered as the deemed owners? So if one initial owner or the main owner transfers his or her property to a spouse or minor children as a gift or something else, then it is basically not taxable in the hands of the owner, because he transferred his ownership, but the owner will be regarded as if the owner, as he transferred this to his spouse and minor child, and all the income from that property will be taxable in the hands of the original owner. This is called deemed owner. Holder of an impartible estate. So if the owner is an holder of any impartible estate, any member of cooperative society, they can also be regarded as if deemed owner. Person in possession of a property, a person who is in possession of a property, and basically for a person having a right in the property for a period not less than 12 years. So 12 years, if the property is actually in the hands of any particular owner, it is deemed as if the owner of the property, and as he or she is becoming the owner, he or she is liable to pay tax, and his or her income of that property will be taxed under the head house property, right? And okay, kindly go to the previous slides where the unrealized or arrear rent was there. Can you go to the slide? This one, 14, slide number 14. 14, previous one. Yes. So this is another provision under section 25A. It's a basic provision, nothing to be discussed in detail. Sometimes what happens, we have discussed earlier the concept of unrealized rent. So what happens sometimes in a certain year, in certain previous or earlier previous year, we have some unrealized rent. So for example, 1 or 2 months rent we have not received, being the owner of the property. But the tenant may pay the same rent in upcoming years. That is, after the year of its actual occurrence, or 2 or 3 years after the after its actual occurrence. Now, when it is actually occurred, we have deducted from the annual rent or actual rent receivable, right? Now, in that year, it has not been taxed. But the thing is, it will be taxed in the year when it is actually realized. So it means arrear of rent or unrealized rent received subsequently. Say, for example, in the year 2021, we have one unrealized rent from one property for 2 months. Every month's rent is 10,000. So total amount of rent is how much? 2 into 10, that is 20,000. So 20,000 we have not received in the year 2021. But in our current previous year, 23-24, we have received the rent, the unrealized rent in that year. That year we have in year 23-24 under section 25A. This amount will be added with our income in this previous year, but subject to 30% of rent that is to be realized. So how much amount of unrealized rent was there in 2021? 20,000, 10,000 for 2 months. Now in the year 23-24, we are supposed to get this 20,000, but the whole amount of 20,000 will not be taxed or not be added with your income from house property in 23-24. But 70% of that, that is 30% deduction will be there. So 70% of 20,000, so it is around 14,000, will be added as if arrear rent that you have realized in that year. And also keep it in mind what happened. Arrear rent you may receive very after a very long time. So for example, you have an unrealized rent 10 years back. You have received this rent after 10 years, but when you are receiving the rent, probably you have sold the house and no one is there. You have lost the ownership of the house, but you are right now realizing those unrealized rent. At that situation also, this rent will be taxed in your hand, although you are not an owner at that time, and it will be taxed under which head? Income from house property, right? So I think this part is clear. Kindly go to the last slide. Okay, so this is regarding the deemed to be let out concept. So sometimes what happens, so in this regard of deemed to be let out, I should also discuss few things. First one, sometimes we can use one single property partly for let out and partly for self occupied purpose. In that case, we can have different treatments, right? So for example, we have a two-stored building, right? Two types of cases are there. In first case, for example, it is area wise usage. So say for example, we have a two-stored building. First floor that we have, it is given in let out purpose, and in the ground floor the owner itself using for his own self occupancy purpose. Now the first floor will be taxed as if the property is self occupied, and whatever the total amount will be there, it will be uh, proportionate according to the case maybe, and the first floor will be taxed as if the property is a let out property. But another type of bifurcation of usage of house property is there, that is our year wise occupancy. So what happens, say for example, one house property is there, no such bifurcation regarding the area is there, but we are using the same property during the certain previous year for different purpose. Say for example, for the first 5 months we have used one property for our self occupation purpose, but for the rest 7 months we have used the same property entirely. No such bifurcation will be there area wise. Entirely for the first 5 months we have used the property for our self occupation purpose or self occupants purpose, and entire property after the for the rest 7 months during that previous year we are using the property for our for let out purpose. So at that point of time, throughout the whole year, it will be deemed to be let out. The 5 months that we have used for self-occupancy purpose, it will not be taxed separately as if a self-occupied property, right? And one more thing, that is, in case of one more than one property you have, how much property will be considered as a self-occupied property, and you can avail all the benefits of self-occupied property, that is your interest on loan and all the things, and how much amount of property, or how much number of properties, how many number of properties you can consider as if deemed to be let out. Now, as per the recent provision, if an assessee owns more than two self-occupied property, if the property is let out, there is a no confusion. Let out property will be computed individually and separately as we have seen the computation. But if we have more than two properties, say for example, one person can have three house properties at the same time, right? Among them, three properties he or she has and using for his own self occupancy purpose, where one property his family is residing, in one property his parents are residing, and in another property his relatives are residing. All these three properties are owned by one single owner, and he is having self occupancy for these three houses. But as per the recent regulation, among them, maximum two properties can be considered as if your self-occupied property. And if the properties are self-occupied, for maximum two houses, your NAV will be zero. And you can claim interest on loan for that two property. So finally, your income from self-occupied property will be negative, because from zero, if we deduct something, it is negative. But for the third house, even if it is used for self-occupation purpose or self-occupancy purpose, still the house will be deemed to be let out. That means for him, for that house, we have again computation of the let out property. First, we will compute the RER, then that is the reasonable expected rent. Then we will compute the actual rent receivable. Then we will compute the GAV and municipal tax. All the computation will be done as if the property will be deemed to be let out. So right now, this benefit is only extended to two properties maximum. Not more than two properties will be there that can be used for your self occupancy purpose, right? So to be very specific, in this case, which two properties you will be considering for your self occupancy purpose, that is your tax planning. So if you plan your tax prudently, then you can avail maximum reduction if you have more than two house properties, and for which house properties you will have minimum amount of uh, tax or minimum amount of income. That totally depends on your tax planning. So this is the overall discussion on the topic income from house property from my end. Thank you so much.
Thank you so much, sir, for your lucid explanation on the income under the heads of a house property. First of all, you have explained all the workings and everything very clearly, and I don't think there is any confusion for the students while they are solving the problems on the income under the heads of house property. Thank you so much, sir, once again for bearing time with us out of your busy schedule. Thank you so much, sir.
Thank you so much. Thank you so much for giving me the platform to deliver my lecture. And I think it will be beneficial for the students.
Yes, sir, it will surely beneficial for the students, and we hope we will get your lecture in the future also.
Okay. Thank you so much. Thank you.
We are ending the session. Okay.
Okay. Okay. Thank you so much. Good night.
Good night.
Ah.